This is Andrew from DeFiancy. All right, guys, we're just going to jump straight into this per usual. So right now we're looking at the S&P 500, and I thought it would be smart to start with it. We're going to finish off talking about crypto, but I think it's really smart to start with the S&P 500 because I think crypto is going to recouple with the legacy markets going into the next few months. We'll go into that here in a second, but let's just look at this for what it is. So yesterday, we solidified a rejection off of this 21-day moving average. So that's this top blue line here. And actually, you know what? Let's go back a little bit. So the month of December was a very nice month for stocks, okay? And the S&P 500 ended up doing really well. We ended up closing the year pretty much up here. I think we actually closed somewhere around here, so almost at the high of the year. And everybody kind of knew that we were going to have some sort of sell-off coming into this early part of January, mainly because you have a lot of people who they don't want to sell at the end of the year because it creates a taxable event, and they may wait to sell in the new year. And also, let me just point this out that we had 1, 2, 3, 4, 5, 6, 7, 8, 9 week straights of upwards price action, which is not unheard of, but it is actually one of the best rallies on record. I think this is well warranted that this happened, but people are naturally just, a little cautious considering, how big of a move this was. So here we are. Okay, so we've had this sell-off over the last really all week, and we're closing another day in the red here, about to close another day in the red. At least it looks like that now. And I don't think this is very I don't think this is like a big deal or we should be changing our strategy going into this year. This is really just kind of mechanical. Again, you had a lot of people in profit up here. This is when you were going to have some sellers step in. People kind of expected this, and what do you know? That's what's happened. Now the question is, how big of a pullback are we going to get? And I'm not totally sure about that, but I think it's pretty likely at this point that we're probably going to test this 4,600 level, given that we are not holding this 4,700 level as of right now. We had a firm rejection off of this 21-day moving average, and you don't really have support, in my opinion, until you get closer to 4,600. So this is where I think people will start to step in and buy. And I don't know if it's a straight line there. It might be quite choppy. But I think eventually we're probably going to come close to this area, or maybe just above it. But that's really where you get to your first major moving average outside of this 21-day. Typically, you want to stay above this 21-day if you're like in a really strong trend. It's usually a sign of weakness when you fall below it. And the next moving average that really matters, in my opinion, is the 50-day moving average. And that's at about 4,600. And I don't really think that there's anything to worry about unless we got under this 100-day moving average. That's when you would have to start to question really the strength of the market. I don't think we actually make it to 4,500, but if it were to happen, you'd still be in a bullish structure on the higher time frame. It's really going to take a lot to get this market in a bearish structure. I think you would need fundamentals, obviously, to change. And I think right now, what the market is really trying to figure out is, did we jump the gun too quickly on rate cut expectations? So right now, the market has priced in like 6 rate cuts for 2023. And this might be a little bit contrarian, but I don't actually think it really matters what the Fed is saying at all at this point. They would really have to say something pretty dramatic, I think, to change what I think is a global risk-on environment. We talked about how global liquidity is going up, okay, and inflation is going down. So I'm not really concerned really about rate cuts. I mean, I think that rate cuts will come. So I don't actually think that is necessarily what's going to stop this market. Even if people thought that rates might stay a little higher for longer, all that does at that point is just keep you sideways. Maybe that would keep you somewhere at sideways between this high and this low here, or maybe lower, but I don't think it would really change the trajectory of the market. The only thing that's going to change the trajectory of the market is if global liquidity starts to go down, earnings are bad, or inflation, so CPI inflation, is going up. So with that said, next week we have the CPI print coming out on Thursday. So this is going to be important because right now I think the market has already priced in that this CPI is going to be coming down, or at least staying down. If it comes in, maybe where it was last month, I don't think that's necessarily a bad thing either, but we definitely don't want to see this increasing. We also get the core PPI on Friday, but the CPI is really what the market wants to see. Today, you had non-farm payroll, which came in hotter, but I want to put a little bit of an asterisk on that non-farm payroll. This thing has been known to be quite inaccurate. They do revisions for these numbers, and oftentimes the revision is quite different than the number that comes out initially. So I don't really pay attention to this as much anymore because I think that I really don't believe the market is where it was last year, which is that it really cared about these data points a lot. Don't get me wrong, I think it cares, but I don't quite think we're in that environment anymore. I think we are really going to be moving into an environment that's really focusing on earnings. I think earnings are the most important thing to focus on in 2023, meaning if you get some data point that might not be that great, and there's a little bit of speculation in that because some people want to see bad data, some people want to see good data, depending on your thesis. But I just don't believe that this really. I guess the market was just in a really different place a year ago, where every single week it was just data. That's all that mattered, and it was just changing the market. Every other day, a lot of chop because it really thought that the Fed was going to hold the rates higher and maybe even increase them beyond what where they are now. We already know now that the Fed is not going to be increasing rates. If anything, they're going to be cutting them, and they have good reasons to cut them if you really think about this logically. And this is, again, contrarian, really, because a lot of people will say, oh, well, the Fed really doesn't have any reason to cut rates. I just don't believe that. So this is how I see it. I could be wrong. Look, I'm a day trader, but I do think that it's important to understand this, so I've thought this out, and this is just how I see it. The Fed has already really won. They've gotten inflation down to 3%. Okay, their target is 2%. It was at 9%. And I think it's insane if to think that the Fed would try to destroy the economy, because that's what you're talking about here when you keep rates up well beyond the appropriate duration. You're going to destroy the economy to go from 2% inflation or 3% inflation to 2% inflation? That just isn't logical. And I think they've thought this out, and they're like, look, you're at risk of overdoing this. There are going to be rate hike delayed effects. We know that that's going to happen. We haven't seen them yet. Or maybe we are starting to see them, like this U.S. ISM Services PMI. It came in cooler. Now, it didn't come in significantly cooler, but I think you're going to start to see the economy slow a little bit. I don't think we go into a recession, but I think the data starts to slow. I think it starts to show some slowing. Maybe it doesn't, but basically what I'm saying is there's a good chance that there are delayed effects that haven't even hit the economy yet from these rate hikes. So I think they know that, and this machine has a lot of, or this system has a lot of inertia, meaning they may go and cut rates, but it doesn't actually have the intended effect until later. Just like when they increase rates and the effects may not be felt for a year or two after, the same thing is with when they cut rates. So I think they're going to cut rates sooner than people think because they really just do not need to keep them up at this point. They've already got inflation at 3%. And I really don't believe that they're that stupid. Again, maybe I'm wrong. I just think that this is a no-brainer that they've already kind of won. And why would you want to destroy the economy to get it just a little bit better, which is 2% from 3%? I mean, the average consumer is not going to be able to tell a difference. Inflation's really, realistically, a lot higher anyway. It's really probably about 10%, but that's a whole nother conversation. So I think we're not going to be talking about this stuff a year from now. I really think the market participants that are really focusing on this stuff still, they really just need to shift gears to earnings. This is my opinion. Maybe I'm wrong. So how does this translate into? Oh, actually, one more thing. So this is a chart that shows from January to May of an election year, which is this year, the performance of the S&P 500 is often lackluster. However, as the year progresses, the market typically improves and delivers robust performance. Basically, what this chart is showing is that during an election year, the first few months of the year is usually not very good. And this is kind of what I think is going to happen this year, which is that we had the rally at the end of last year, and now the market is kind of like breathing, and people are taking profit, people are being patient. But I don't think it's going to last all that long. I think as long as global liquidity is going up and earnings, if they come in good over the next few months, we're just going to go back into this bull market. Now, what does this actually mean for crypto? Multiple thoughts on crypto here, but I wanted to show you the S&P 500 because I think that crypto is going to be following it a lot closer than it typically has. So here's Bitcoin. I showed you those moving averages. Look how well Bitcoin has performed. It's basically stayed, or it has stayed above its 21-day moving average for this entire rally. It has not stayed below that average for more than a few days, and here it is above it. It hasn't even, well, it did test this 50-day moving average here the other day. So this was a nice reaction off that level. It's going to take a lot to make this structure look bearish. I do believe we're potentially topped here, but I don't really see that as a big deal. If you have positions that are for the long haul or just for more than a few months, this price action is just going to be insignificant. Now, don't get me wrong, a pullback here to like 38 I think is perfectly reasonable, and honestly, I wouldn't get really concerned until you get under 35, to be honest. Which, by the time it would get here, it probably would be closer to this 200-day moving average. So really, I should probably say this. Once you're under the 200-day moving average, so let's remove that. Once you're under this 200-day moving average, that is when you would want to be cautious, because Bitcoin has a history of becoming quite bearish once it gets underneath there and is unable to get back above it. But we're well above it, so Bitcoin has a lot of room here to just kind of play around here. People taking profit. We'll see what happens. I mean, I just don't think people need to get bearish here, but I also realize, look, you need to be able to, withstand a 15% dip at least. This is what you're looking at potentially. Dip-wise, I don't think necessarily that happens. I'm just saying that needs to be programmed within your risk tolerance or your risk management plan. Okay. If we look at some of these altcoins, they have quite a bit of room they could go down to before I would get bearish. So if you look at Solana, for example, it's still above its 21-day moving average, which is quite impressive, and it doesn't even, it hasn't even tested its 50-day moving average, which is about 15% lower. For me, I think once we get to around 80, something like that, 75, 80, that's when you would want to see some buyers step in for Solana. You would hopefully see, we would want to see it starting to slow down to the downside if it got there. But until you get there, that's what you need to start, preparing for. Planning is, what do I do if we do get a dip? Because that's, like I said, it's a 15% dip, or actually that's about a 20% dip, or to 75, and then in my opinion, you could probably see a dip even lower, maybe to like around 65. These dips would be for buying, and I think this is the time to plan on what would you do if prices got down to those levels, because ultimately, at the end of the day, for crypto, the only thing that's going to matter is global liquidity and TradFi. Okay, so earnings will actually unironically matter for crypto, because although crypto hasn't been perfectly correlated with equities, I think it will be quite correlated with legacy markets as the spot Bitcoin ETF becomes more influential. Legacy investors are going to invest in Bitcoin when under certain criteria, and that criteria will be very similar to the criteria of why they would buy the S&P 500. When they're risk on, they're going to buy Bitcoin. When they're risk off, they won't buy Bitcoin. So inevitably, this is going to make Bitcoin quite boring, I think, maybe in a way, because it's just going to follow the S&P 500. It'll probably be a higher beta to the S&P 500. Or conversely, it could just follow gold. Logically, it would follow gold. I just don't know if it has matured enough. I don't know if investors have become informed enough to know that this is a digital gold. Talking about the newer guys that might be coming in to buy this spot Bitcoin ETF. But so there's a question mark there. I think naturally it probably will follow the S&P 500. We know that it has in the past when you had a lot of legacy trading firms that were trading it in 2022, it followed it perfectly all of the time, basically. Good chance that's going to happen. But don't be surprised if over time, or maybe even earlier than later, that it follows gold, because ultimately that's what it really is a digital gold. Okay. I think that's pretty much all I want to talk about today. Until next time, happy hunting, friends.